Hello and welcome to this video on forecasting. To value a business, it's really important that you understand the business and understand the business's accounting before you start the forecasting process. Because forecasting is going to be the most important step in the valuation process. If you want to make money from investing in the stock market, the thing that will separate you from other investors is how well you are forecasting, how good you are at predicting the future and understanding what's likely to occur within a business as it progresses through time. So the reason why we do understanding the business and understanding the accounting part of the course first is because this is going to help us understand the forecasting. It's going to give us a good understanding of what's happened in the business's past so that we can hopefully use that information to predict the future. So forecasting is going to be our most important step in the valuation process. And it's really important for a range of careers within accounting and finance that you are able to do some forecasting and understand the difficulties of it. So whether you go into something like management consulting, equity analysis, any sort of valuation related roles, they're all dealing with forward-looking information. They're all focused on the future of a business. So forecasting and looking towards the future of the business's performance is a key step in any of these particular jobs or careers. So whenever we do forecasting, we usually start with what's happened in the past. So a key starting point is going to be any time series behavior. So historical information about key measures that we want to forecast, such as growth and return on equity and all the different components of that. I just want to give a little bit of a disclaimer. In this particular video, we're going to be talking about a very specific set of forecasting techniques for forecasting financial statements. Forecasting as a whole is a huge field. There's a lot of research into forecasting, and there are really skills that you can develop and learn that will improve your forecasting. There's a professor of psychology, Philip Tetlock, who does a lot of research into this field, and his book, Super Forecasting, will go into a lot of detail about forecasting and how you can improve your forecasting. I recommend looking into it if you want to get into the investing side of things, if you're interested in the stock market, understanding how to improve your forecasting skills, because it is a skill that you can practice and make mistakes and learn from. Have a read of this book, have a read of Professor Tetlock's research. It's fantastic at helping you improve your forecasting skills. The forecasting we're going to be doing is comprehensive forecasting of the financial statements. So we're going to be creating financial forecasts that involve the balance sheet. So things like our assets and liabilities, but it'll be reformatted balance sheets. So it'll be our net operating assets and our net financial obligations. We'll be looking at the income statement. So the net operating profit after tax, NOPAT, and our net financial expense after tax, NFEAT. We'll be forecasting those items. And also cash flows are important. So we'll be forecasting our free cash flows for the firm as well. We're going to be making sure our forecasts are all interrelated so that our accounting still holds, so that our balance sheet still balances, that our profits from our profit and loss statement flow through into the ending equity balances for the following periods on our balance sheet. So our accounting is still holding. To do these comprehensive forecasts, we're going to make 6 individual forecasts. So we're going to keep this relatively simple, and we're going to try and only forecast 6 items for our business. And using that, we can then build the financial statements and make sure everything balances out. So the 6 items we're going to be forecasting are the firm's sales growth, the asset turnover ratio, the profit margin, other comprehensive income, net dividends, and the net after-tax cost of debt. So the first thing we're going to be doing is forecasting sales growth. And from there, we're going to be making these other forecast assumptions and building up our comprehensive financial statements based on our forecasts. So here it is. Here is our forecasting template that we're going to be following to make sure we create these comprehensive forecasts. This is not the only way that you can forecast a business's performance. This is just one way that is logically consistent and minimizes the amount of mistakes we can make. So this is what we're going to be doing in this subject. We're going to be following this 10-step process to create some comprehensive financial statement forecasts. So let's get into step 1. Step 1 is to forecast the sales growth. So your sales revenue is equal to the quantity of goods that you sell times the price for each of those goods that you sell. So when you're trying to forecast your sales figures, you need to be thinking about, will you have a change in the number of products or services you're likely to sell? So the quantity, will you be opening new stores? Will the firm improve sales per store? What's the average sales growth over the last years? These are all things that you'll have to research in trying to think about what is the quantity of goods or services we'll sell in the future. Similar story for the price. Does our firm have the power to determine and make its own pricing decisions? Is it in a very competitive industry where we don't have much pricing power? Or are we a monopoly provider and we can set our own prices and customers will take the price changes? Do we set our prices based on a fixed markup on costs? Will inflation influence our pricing? Or are we selling commodities into a commodities market and have very little power or knowledge over future pricing? Then we need to know a little bit about how sales growth often behaves. And over the long term, sales growth rates, so the percentage that your sales are growing, are often mean reverting. Firms that are doing above average will slowly come back to the average, and firms that are below average but are still surviving often improve over time and come back towards the average. And in the very long term, your sales growth will not be greater than GDP growth for the market that you're in. This figure illustrates how sales growth can be mean reverting over time. So this line here, this grey line, is firms that were in the top fifth, so the top 20% of high growth firms. So in the first year, these firms were experiencing sales growth of about 70% per year. And then over a couple of years, this growth rate falls back down to about average. Okay, it's mean reverting. So by about 7 years, these firms were down in the middle of the pack with sales growth just under 10%. The firms down here, which were in the bottom 20% of firms with sales growth, which were experiencing declines in their sales, after a couple of years, they were able to turn things around and get back to the average of around 10% sales growth over time. So this is important because if you're trying to value a company that's struggling at the moment, if managers change, if they change their strategy, readapt to the market, we may see in the future that they can get their sales growth back. Or if we're looking at a really successful company now, over the next few years, their competitors might improve, they might innovate, and they may start taking away market share. So this firm's sales growth may decrease. Or if the business is really successful, there's just no customers left to sell to. Something like Apple is very hard to continue growing their sales at 70% per year because their sales are already so huge and they're really tapped into most markets around the world already. To continue sales growth at that high level for multiple years into the future will be incredibly difficult. So when you're doing your forecasting of sales in Excel, it's pretty simple. You look at your actual financial statements and you have your sales revenue to start with. After researching your firm lots and really getting a good understanding of the drivers of their future sales, the quantity, the prices, what the business is doing, if the industry is going to be growing or shrinking, changes in the firm's accounting that might show up in the sales revenue, all this knowledge that you have about the business will show up in these numbers here. The estimate that you have for the sales growth. So, for example, in this year, 2017, Anna's company, we expect 20% sales growth. So in 2016, we had 50,000 in sales. In 2017, we expect that number to be 20% higher. So we'd multiply 50,000 times 1.2, 20%. Then in 2018, we'd multiply the 60,000 sales by 1.18 to get the new sales of 70,800. So whatever sales growth rate estimates you come up with based on your research, you multiply through the previous year's sales by 1 plus the percentage change to get the new estimated or forecast sales revenue for that year. Next up, we're going to look at step 2. Step 2 is to forecast ATO, the asset turnover. And then after we have forecast ATO, we can then calculate net operating assets, NOA. The asset turnover ratio tells us how effectively we are utilizing our assets to generate sales. So if we have a very simple business like we're running a coffee shop and our main asset is a coffee machine, how many sales can we generate from that coffee machine? How many coffees can it make? How many customers have we got coming into the door to actually buy those coffees? Okay, if we've got a really high asset turnover ratio, that coffee machine is going to be running all day and we're generating lots of coffees and selling those products to customers. If we've got a low asset turnover ratio, we've got this expensive coffee machine and we're only using it to make a few coffees a day and it's not generating many sales. So the asset turnover ratio generally tends to be pretty stable. And that's partly because different industries require different assets, and the assets or the technology used in those industries generally are pretty stable in being able to generate sales. There are some exceptions with very high asset turnover firms where it tends to decline and stabilize over time. So here, similar to when we were looking at the sales growth, we've broken up each of the sort of companies into the top 20% and bottom 20% and in between for their asset turnover ratio here. So firms that are in the top 20% of asset turnover ratio, we can see after a few years it decreases a little bit, but they're still significantly higher than the rest. Firms that have low asset turnover, stay having low asset turnover. Now, this is because asset turnover is heavily driven by the industry's technology and, of course, your strategy. So a firm like Woolworths is always going to have a high asset turnover ratio because supermarkets need to have high asset turnover ratios to survive. Whereas a company like a steel manufacturing company will have a low asset turnover ratio. And they'll always have a low asset turnover ratio because they need to invest in huge fixed assets and plants to manufacture the steel, and they'll have much lower assets or sales based on those huge investments in assets. So it's based on industry, and it's also based on your strategy as well. So after you've researched your firm's asset turnover in the past and thought about what changes might happen in the future, will we be changing our asset base? Are we going to be getting more or less customers that are driving ATO? We forecast the asset turnover into the future, and then we calculate net operating assets. And that's equal to sales, which we have just forecast in the future years. And we divide the sales for 2017 by the asset turnover for 2017, and that gives us 2017's NOA. Then we do the same for 2018. Sales divided by asset turnover gives us NOA for 2018, and so forward through the years. So at this point, although we have only explicitly forecast the sales growth rate and the asset turnover, we've been able to calculate one of the key terms from our reformatted balance sheet, which is our NOA. Step 3 is to forecast the profit margin and then calculate our NOPAT, our net operating profit after tax. So profit margins are more variable relative to an asset turnover ratio, but they do tend to be driven towards normal or the average by competition. And this is why it's really important to have done an industry analysis before you try and do your forecasting. You need to know the level of competition within your industry. You need to know how your firm is competing against other firms, because it's going to really help you forecast a firm's profit margin. So profit margins can be driven down to average by competition. However, your strategy will still heavily influence your profit margins that you see. So Ferrari will always have a higher profit margin than Toyota. It's part of their strategy. Toyota will always have a higher asset turnover than Ferrari. It's part of their strategies. Okay, but if you are a successful business with a high profit margin in a highly competitive industry, if your competitors are able to innovate and catch up with you, you will have to eventually lower your prices to compete. So profit margins will have pressure downwards in highly competitive industries. So similar figure as before, firms in the top 20% of profit margins, we see it's reasonably stable. It drops down a little bit over time from maybe something like 16% down to about 12%. There's a little bit of pressure there, but they're going to be your differentiated businesses. And then down here, we've got the firms that are struggling and making losses, and they're either going to go out of business or eventually turn things around and get a positive profit margin again. Okay, and then in, say, the second and third quintiles, we can see that, again, it's relatively steady over time, consistent with the business's strategy that they're undertaking. So when it comes to the spreadsheet work for forecasting profit margin, we have forecast a profit margin, for example, here, 6.5% each year. We then use this 6.5% and multiply through by the sales revenue to calculate the net operating profit after tax. So remember, this profit margin here would be your operating profit margin from your reformatted statements. And that's why the profit margin times the sales will give us our net operating profit after tax here. We can do that for each year. So now we've made 3 different forecasts. We have forecast sales growth, we've forecast asset turnover, and we've forecast profit margin. And these are our 3 operating forecasts. So when we think about operating versus financing activities, we've just made 3 operating forecasts: sales, turnover, and profit margin. From there, we can then calculate the firm's free cash flow. And we say that free cash flow is equal to NOPAT, which we just calculated, minus change in NOA, and we just calculated NOA previously. So from these 3 forecasts, we can calculate the firm's operating assets, operating profits, and their free cash flow for the period. And it's going to be very powerful because we can then use those numbers in our valuation models later. So on our spreadsheet, when we want to calculate our free cash flow, we know that we have got our net operating profit after tax that we've just calculated from sales times profit margin. And we previously calculated our net operating asset. So the formula is change in NOA. So we need to take the current year's NOA minus the previous year's NOA to get change in NOA. So NOPAT that we just calculated minus this year's NOA minus previous year's NOA gives us our free cash flow. So after step 5, when we just calculated the free cash flow, we finished our operating sections. We also know that a firm's financing activities are still important to understand. So now we're going to be forecasting the firm's financing activities and seeing how they're creating or changing the business activities through their financing decisions. So step 6 is to forecast the net dividend payout ratio and apply to NOPAT. So what we're going to be forecasting is the dividend payout ratio. What proportion of the firm's NOPAT will they be giving back to shareholders? So our dividend payout ratio is going to be some sort of percentage, and we think they may pay out, say, 60% of their operating profits and give that back to shareholders as a dividend. We then have to calculate net payments to debt holders. So our financing activities refer to financing flows to debt holders and to equity holders. Payments to equity holders would be our dividends, and paying back our loans would be payments to debt holders. Okay, so financing activities relate either to your equity holders or your debt holders, and we're going to calculate our dividends, payments to to equity holders, and we're going to calculate F, which is our payment to debt holders. So when we're forecasting our dividend payout ratio, firms generally like to keep their dividend policy reasonably stable over time. So you'll see that firms' dividends will generally be relatively consistent with small incremental updates each year. They're not too volatile. So we can normally get a reasonably decent idea of the amount of dividends that they'll pay out. What can vary a little bit more is if they've engaged in share buybacks or issuing new shares. So we have to look at that as well, because when we talk about dividends here, it's net payments to shareholders. So a share issuance would be a negative dividend. Okay, so we need to take that into account as well. Then finally, because our financing activities are either to equity holders or debt holders, whatever free cash flow is not paid to our shareholders must then be paid back to our debt holders. There's only 2 uses for free cash flow. One use is for payments to shareholders. The other use is for payments to debt holders. So step 7, we've estimated 35% of our operating profits are likely to be paid as dividends to shareholders. So we multiply our NOPAT figure by 35%, and we then get our forecast dividend payout. So you multiply the NOPAT figure by your dividend payout ratio that you have forecast. Then step 8, calculate net payments to debt holders. We say the free cash flow that we've calculated up here minus the dividends that we expect to pay is what is left over to be paid off to debt holders. So out of this $1,519 of free cash flow, it must be split between dividends and payments to debt holders. If I've estimated that $1,365 is going to my shareholders, then the remainder, the $154 remaining, must be paid back to my debt holders. Now remember, we could have a negative number here. A negative number would indicate we have borrowed more money. Okay, so if we have a negative payment to debt holders or a negative payment to a negative dividend, it means we've either raised capital from our shareholders or raised capital from our debt holders. We're now up to step 8, and that's forecasting net after-tax cost of debt, net borrowing cost. So essentially our interest rate that we have to pay on our debt. And we're going to use that interest rate forecast to then apply to the opening net financial obligations, which is how much money we had borrowed, the amount of money we owed at the start of the year. So how much money we've owed at the start of the year times the interest rate will give us our net financial expense after tax. That is how much interest we have to pay. The amount we've borrowed times the interest rate tells us how much interest we have to pay. Net financial expense after tax is the amount of interest we pay during the year. So it equals the amount of money we borrowed at the start of the year, NFO at T minus 1, prior year's net financial obligations, times the net borrowing cost, our cost of debt capital. So we can then calculate our current year's net financial obligations. How much money we owe at the end of the year is equal to how much money we owed at the beginning of the year, plus any interest we have to pay, minus any repayments we've made on the debt. So this term F is probably the most confusing part of the template where people make mistakes. F was calculated here. It's the net payments to debt holders. How much of your debt have you actually paid back during the year? My ending debt balance is equal to my starting debt balance. My starting debt balance will increase as I have more interest that I have to pay, and it will decrease as I make repayments on my loans. Okay, and that will give me my ending NFO. And it says check leverage. Businesses often have a goal amount of leverage. So they might set a target of say 30% or 70% debt to equity ratio. And it's normally relatively steady over time. So when you do your forecasting, just check it out and see if you're forecasting the amount of debt to be relatively constant over time. So a few things to remember here with our debt calculations. We're going to forecast the after-tax cost of debt. So if you see the interest rate is say 3% for your firm's loans, interest expense is a tax deduction. So we have to calculate the after-tax interest rate. So it'd generally be 3% times 1 minus the tax rate, which is normally 30%. So you'd say 3% times 0.7 would be the after-tax rate of interest. As I mentioned before, leverage tends to be stable, but let's look at some of the data. Again, we've got our firms broken up into quintiles. So our top 20% of firms, these are the ones that are really willing to use a lot of debt, and they're able to maintain that over time. These are firms that generally are relatively safe and operating with a safe and secure business model, and they're able to use more debt because they can take on financial risk because they've got low operating risk. They've got some firms that use very little debt or may even have negative debt, which means they've got more financial assets than financial obligations. And these firms, again, they've built up these financial assets and they're safe and sound businesses and they keep it like that. And then we've got different levels of debt for firms that are going to generally have different levels of operating risk. They stick to what they believe they can maintain over a long period of time. So firms' leverage ratios don't fluctuate a lot over time. They normally have a goal that they want to stick with for mature firms, and they just want to keep it at near that level as long as they can. So our final few Excel calculations here. When we forecast our cost of debt after tax, we get our opening debt balance. This would be net financial obligations from the previous year. So in 2017, my opening debt balance would be my closing debt balance from 2016. Okay, my closing actual 2016 net financial obligations would be my opening debt balance in 2017. I calculate the cost of debt, or the net financing after tax. 6.5% interest rate times the amount I've borrowed gives me the amount of interest I have to pay. I then calculate the closing debt, which is my opening debt, plus the additional interest that I owe, minus any repayments I made during the year, and that gives me my closing debt balance. This closing debt balance here, $5,623, then becomes the opening debt balance in the following year. In calculating the closing debt, we then add the extra interest of the year, minus any repayments to get the closing debt balance, and it opens the following year. So it keeps going on like that. And we calculate leverage. We can do something like a net financial obligations to NOA ratio and see how it's going over time. In this example, the leverage is decreasing quite rapidly. The firm's paying off their debt. Now, is that going to be realistic for a real business? Some businesses do want to pay off their debt and have less leverage, but most usually use leverage as a cheaper form of capital that they can use to lower their tax bill, and they're happy with the amount. So a lot of firms wouldn't have such a dramatic payoff of debt. They'll borrow again as they start paying it off. So we're pretty mumuch finished now. Steps 9 and 10 are just checking that everything is still balancing out. So we're going to be calculating our comprehensive income equals NOPAT minus NFEAT plus any comprehensive income that you may have forecast. And then we calculate equity two ways to make sure it balances out. We use owner's equity equals NOA minus NFO, and owner's equity equals owner's equity last year plus comprehensive income that you just calculated here minus any dividends paid out, which you have calculated up here in step 6. So those formulas are pretty easy to pop into Excel. Our comprehensive income was going to be NOPAT minus any NFEAT, and owner's equity is going to be calculated two different ways, NOA minus NFO, and opening owner's equity plus comprehensive income minus dividends, and we make sure they balance out and they give us the same number each time just to check that we haven't made any mistakes there. This video has presented a 10-step forecasting template for you to use. The advantage of this is that it allows us to forecast a comprehensive financial statement set. It allows us to forecast the key items from the balance sheet, the income statement, and the cash flow statement, all making sure we're logically consistent because the financial statements are still articulating within themselves. So This is going to be a fantastic way of learning how to forecast. It's not the only way. It might not be the most fantastic or best way, but it's a consistent way that's really a great way to learn how to do forecasting. And because forecasting is the most important step in the valuation process, this is a good way to get started with it. If you're interested in investing, if you're interested in the stock market or working in that field in the future, to make sure your investments outperform the market over the long term, the thing that you're going to have to be good at is forecasting. You're going to have to develop some sort of competitive advantage in forecasting, which will require fantastic research skills, strong accounting knowledge, or learning from your mistakes and thinking about things in a balanced way. Think about every situation, pros and cons, bull case and bear case, and try and get as much diverse information to make your forecasting decisions. Forecasting is difficult. You're going to make mistakes with it. No one has a crystal ball that's right 100% of the time. Give it your best chance. Give it your best shot. Think about things. Try and be critical in the way you're thinking about things. And we'll talk more about forecasting strategies in our next video. Thank you very much.